Hey everyone, welcome back to the IX. Today we're diving into something that's super important, but doesn't always get the spotlight it deserves, the Producer Desire Index, or PPI for short. It's one of those things that might sound boring at first, but trust me, it has a big impact on how the economy works and how we see the markets. So stick around and by the end, you'll be a PPI expert. Alright, so first off, what exactly is the PPI? In simple terms, it's like the CPI's big brother. While the CPI measures what you pay for goods and services, the PPI tracks what businesses pay to produce and sell their stuff. It's basically a way of tracking how much it costs for companies to make things and how those costs change over time. Think about it this way. When it costs more for businesses to make products, they often pass those higher costs on to us, or higher prices for everyone. That's why the PPI is a big deal. It can give us a sneak peek into what might happen with inflation before it hits us at the checkout line. Now, let's get a little historical here. Don't worry, we'll keep it short. The PPI actually started out as a Wholesale Price Index, or WPI, way back in 1891. Yup, over a century ago. Back then, it was mostly focused on tracking the prices of raw materials and bulk goods because, well, the economy was a lot simpler back there. Fast forward to 1978 and the US Bureau of Labor Statistics upgraded the WPI into what we now know as the PPI. It's much more comprehensive today, covering not just manufacturing, but also agriculture, mining, and even services. So it's a lot more useful for tracking price changes across the entire economy. Now let's talk numbers, but don't worry, we'll keep this easy. The Bureau of Labor Statistics, BLS, is in charge of calculating the PPI. Every month they ask thousands of businesses what they're charging for their products at different stages, like for raw materials, partially finished goods, and fully finished products. To make it simple, think of it as 3 layers. 1. Raw materials like metals, energy, or crops. 2. Intermediate kinds of stuff like chemicals or parts used to make final products. 3. Finished goods are the final products you buy, like cars or electronics. The BLS then compared these prices over time. They use 1982 as a base year, which is set at 100. So if today's PPI is 120, it means prices are 20% higher than they were back in 1982. Pretty straightforward, right? Not all industries have the same influence on the PPI. Some sectors, like manufacturing and energy, carry more weight because they play a bigger role in the economy. Here are some of the key sectors. Agriculture, like crops, livestock, etc. Energy, like oil, gas, electricity, etc. Manufacturing, like machines, cars, textiles, services, or otherwise everything from transportation to financial services. So when you hear about changes in the PPI, just know that these industries are driving those numbers. Before we jump into the next chapter, don't forget to hit the like button and subscribe to our channel if you haven't already. Helps out the channel and keeps you in the loop for more content like this. Alright, so why does the PPI even matter? It's actually a huge indicator of inflation, and it can impact everything from your interest rates to your 401k. Here's how. When the PPI shows rising prices, it usually means inflation is coming. This gets the Federal Reserve attention because they don't want inflation to get out of hand. If they think inflation is heating up, they might raise interest rates to cool things down. For businesses, rising PPI can be bad news if they can't pass on those higher costs to consumers. That means the smaller profit margins, which can hurt their stock prices. And that, my friends, can mess with your investments. Let's talk markets. The PPI is a must-watch for investors because it can give clues about where things are headed. Stock market. Rising PPI can be a red flag for industries that rely on raw materials, like construction or manufacturing. Higher costs can lead to lower profits, which is never good news for stock prices. But if the PPI is stable or dropping, that could mean inflation is under control, which might boost the market. Forex. The PPI also play a big role in the forex. If the US PPI is shooting up, investors might expect the Federal Reserve to raise interest rates, which makes the US dollar stronger. On the flip side, if the PPI shows prices are stable, the Fed might keep rates low, which can weaken the dollar. Commodities. Commodities like oil and metals are a big part of the PPI. Rising producer prices usually mean higher commodity prices. So if you're into trading oil, metals, or crops, keep an eye on the PPI's smart move. It's not just about the US. The PPI has global effects too. If US producer prices rise, it can make US goods more expensive for international buyers. This can affect trade balances in the global economy. Plus, other countries have their own versions of the PPI, and big economies like China and Germany can impact global markets. Rising producer prices in those countries can lead to higher costs worldwide. So there you have it. Everything you need to know about the producer price index and why it's more important than you might have thought, whether you're an investor, trader, or just curious about how inflation works. The PPI is definitely something to keep an eye on. If you enjoyed this video, don't forget to like the video and subscribe to the channel for more deep dives into finance, markets, and all things money. Until the next video, may your bank balance grow as strong as your health.